Hello, my name is Nathan Leddard. I'm an analyst in the Morgans research team. This month I have put Sydney Airport back into our best ideas list. This is following the completion of Sydney Airport's recent capital raising. There's no doubt about it, travel restrictions have absolutely belted Sydney Airport's passenger numbers. And this has had a direct and significant impact on their aeronautical and car parking revenue, coming off very significantly, and also caused them to have to negotiate rental abatements with their property and their retail customers. So also seeing those typically what we would expect to see quite resilient lease revenues actually also coming off. So in that environment, Sydney has done what we would expect it to do. They've really pulled back on their capital expenditure. They're cutting out 35% from their operating costs, and they've even done some funky stuff with their interest rate swap book, basically crystallising some swaps in order to reduce interest costs over the next 12 months or so. Look, I thought it had plenty of liquidity and balance sheet strength going into this COVID period. I really thought they might wait until the end or into next year in order to consider whether to do a capital raising, but the capital raising they have done has basically put another $2 billion of cash into their balance sheet, gives them heaps of liquidity to be able to see out this really weakened traffic period. And quite frankly, on my forecast, when they actually do return, when traffic does actually return, I think their balance sheet is going to be stronger than what it was actually going into this period. So certainly a very strong sort of financial position. How am I thinking about this stock going forwards? Look, this is no longer a income orientated stock. I do not think there will be a distribution paid by Sydney Airport until the 2022 into 2023 period. This is now a capital growth story. It's a capital growth story on the basis of capital recovery coming through. When passenger numbers recover, I expect earnings to be able to recover. So passenger numbers recover to pre-COVID levels, I expect earnings to be able to recover to pre-COVID-19 levels also. Given the concession from the airport runs to 2097 and bond rates continue to remain low, I expect also that the share price should also recover. It shouldn't recover to where it was historically, and that's because of the dilutive nature of that capital raising. So somewhere within the sort of mid to high $7 number is certainly where I think we could realistically expect the share price to recover if earnings did recover to the pre-COVID-19 levels. And then it comes down to just how long it will actually take for these passenger numbers to actually get back to where they were pre-COVID. So if we sort of look at that on a sort of a 3-year time horizon, then the potential capital growth here on a compound basis is double digits. So in my mind, certainly justifies putting Sydney Airport, a very high quality infrastructure asset, back into our best ideas list with a medium term capital growth opportunity as the key driver. Thank you.